Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back for another episode of Zen and the Art of Real Estate Investing. My guest today is Mike Madsen from RealSource Residential. We're going to talk unlocking value with carefully chosen multifamily real estate. We go into the why behind multifamily, why they're still bullish on it, and why it's going to continue to be a good asset, along with a whole lot more. Let's go. This is episode 235 of Zen and the Art of Real Estate Investing with my guest, Mike Madsen. Mike is the Vice President of Acquisitions and Economics at RealSource. RealSource is focused on long-term value and sustainable growth. They have a multifamily track record with over $1 billion in cumulative investments and 6,300 renovated apartments. It's probably way more than that because websites are always out of date. Mike, welcome to the show.
Yeah, thanks for having me. It's great to be with you today and talk some real estate. And I think we can see the horizons of a upcycle coming, kind of depending on the market. So a lot more fun to do a podcast than maybe the last few years. So excited to be with you and talk some real estate.
Yeah, I mean, let's get right into that before we get to your whole background in real estate. Why should we be bullish on multifamily? Because the general news consensus might make people think like multifamily is not a great investment. I think you and I both agree that it's always going to be a great investment, but particularly now there's a lot of opportunity.
Yeah, I mean, people always need a place to live, as they always say. But I mean, even the banks taking back properties from deals bought at the wrong time or in the cap rate bubble, they're not selling real estate either. They're putting asset managers in place. And so unless you're in one of those, say, dozen metros that have an oversupply level, we're seeing rent growth return. I think the big story was kind of absorption and how strong the demand side was. But to me, the biggest thing is just understanding the cap rates. And we went through 2021 when cap rates were so overvalued. And I think we're going to look back and see 24 and 25 as when cap rates were undervalued. So it's sometimes such a big overriding factor, but with rent growth returning in a lot of areas and spreads coming in, I think we're going to really see some good opportunity for rent growth and appreciation in the right markets in these years ahead.
Yeah, and even in those markets where the rent is going down, that really came from just an oversupply or overbuild, right? I mean, it's not like we suspect that people are going to stop moving to Texas. I mean, they're going to keep moving to Texas, so eventually these units will fill up.
Yeah, no doubt. And it was concentrated in a lot of areas, but obviously we've seen the starts decrease dramatically. I think we're down 60 to 70% in most regions, and when those fall-offs happen to deliveries, we're going to really see that we're back to a housing shortage, and we're going to see supply and demand drive rent growth again.
Yeah, I mean, it's an interesting dynamic because everybody would agree we have an affordable housing, type of crisis in America, just in terms of people being able to buy homes. But then we have a very, very low start rate. Those two things don't really necessarily go together. So as you said, this is going to have to kind of reconfigure itself pretty quickly when we realize we still need those units to come online, because not everyone's going to be able to buy. There's no inventory to buy because people aren't moving out of their 3% rates on houses. So these people are going to have to be choice renters for a while. And that's why we need the multifamily opportunities out there, right?
Right. And if interest rates are dropping, it's going to be such a dramatic boost to values when and if that kind of happens. I mean, obviously it will happen. It's a matter of when. But yeah, I really kind of see it as a major hedge right now. If you kind of look and monitor kind of PE ratios on stocks versus cap rates, and you look at especially the NASDAQ stocks and you see where these PE ratios have gone, they've kind of gone the opposite direction. And so To me, it makes multifamily a little bit of a hedge to where, even if we have a softening in employment or a soft recession, if that comes with, lower interest rates and people running into treasuries and lower commercial mortgage rates, that could have a big effect and kind of serve as a little bit of an interesting hedge in the equity markets right now.
Yeah, and as you said in the beginning, I mean, there's always going to be a need for more housing. It doesn't seem like, even though people aren't having children as much as normal, it's not like there's just a glut of housing in all areas that are available. And especially when people want to move up to newer properties and see the new builds, that's where the trend is for the old opportunities that people end up recycling in multifamily, the buildings that kind of couldn't keep up with the time with mom and pop owners. Those are going to need to get changed over and kind of all redone, which is all part of the syndication process as well.
Yeah, definitely. I mean, a lot of people felt like we were getting a little bit to the top of the market in 2018. We're definitely in kind of the later innings of the cycle. And we really highlighted how much of that pent demand is there from, like, at the time, millennials kind of still living at home. And it was just amazing. And that household formation has really drove demand. And obviously, post pandemic, a lot of people moving out on their own was a big boost there, but there's still a ton of pent up demand. And we're going to be right back to a housing shortage, unfortunately. And, you look at so many of these markets to where it just doesn't pencil to build because the rents are so affordable.
Yeah.
And some of these markets are markets that still have strong rent growth and strong job growth, but they just don't have, that level of rents that can justify the cost of construction. So there's, a few markets that are going to really get kind of the best of both worlds here. And we're going to see that demand outpace supply and drive rents again.
Yeah. And I mean, what are the most important pieces of data that you're looking at? Obviously, we were just talking about one, though, but when you're evaluating multifamily cities and where could be a good place where there is going to be, again, higher demand, what are the key metrics that you're looking for that might make it worthwhile to invest in the area?
Well, we kind of have a little bit of a niche in kind of playing defense and what I call defensive metrics. And I think as you're in the early innings of the business cycle or macro multifamily cycle, you're kind of playing a little bit more offense than defense. And so the last few years, it's served us really well to look at things on a state level. We started measuring a lot more things like state GDP to state debt ratios and things like that, and kind of naturally finding kind of where the more favorable policies were, understanding that a lot of the policies are set on a state level. So we've really been focused on affordability, and we've really been focused on that expense ratio. I mean, a lot of the expense ratio kind of boils down to average incomes, property taxes, insurance are kind of the big things that separate things. But, you've got markets out there where you can operate multifamily at a 35% expense ratio and some that are a 65% expense ratio. So as inflation has hit expenses, it's really kind of separated the winners and the losers. So we're definitely going to continue to kind of look at those expense ratios and affordability indexes market to market, but we're trying to turn some of our metrics back to the offensive metrics as well, focused on the job growth, population growth, kind of those key fundamentals. But overall, we really want to be in kind of the suburbs of good markets and go where our data leads us and let that boil it down to the top 30. But
yeah. Awesome. Before we get back into the whole cycle in multifamily, let's get back to your beginnings. When was the first time when you were younger that you remember being interested in real estate?
Yeah, my grandfather owned about 30 apartments and operated
Oh,
them very
awesome.
well. And, he did okay in real estate. And somewhere along the line, he just said, "Hey, did you know 75% of millionaires make their money in real estate?" And I was thinking, well, gosh, I got to figure out what I'm going to do. And it just kind of stuck with me. And I bought a house when I was very young and rented the rooms to my friends in college and got my start that way. And by age 20, I knew that I wanted to have a career in real estate, and luckily found a great shop with great people that had a good little niche that just attracted me to the business model. So I've been with RealSource for 20 years this summer, and just always been passionate about what it can do to help you put your money to work and make money and kind of hedge inflation.
Yeah, it's so interesting because I've talked to so many investors who did this live-in house hack before it was even a term. You probably, you didn't coin it anything. You were just probably trying to figure out, hey, this is a great way to make money and live with my friends, right? I mean, it actually just absolutely makes sense and it's fun. But that's actually now become kind of a strategy when it was just common sense to make more money on a home that you bought.
Yeah, I stumbled into it a little bit. I mean, I went to my first day at college having no idea or no plans to do the fraternity thing. And then Pledge Week came along and there I was. And I kind of got into it for a little bit and quickly learned like, hey, this isn't for me. And I've got
Yeah.
plenty of friends and I don't want to put out money. I wonder if we just got our own place. And that's kind of how it started and worked out really well.
Yeah, I mean, that's the easiest strategy, like I said, and it's also fun. And did you find it hard with the rent in the beginning? I mean, you're so young. It's like, do you just take whatever money comes in, or did you figure out how to structure it so your friends would actually pay you? Because that is a tough first lesson for a lot of first-time landlords.
Yeah, it was a great learning experience. But yeah, collecting the rent from your buddies was a tough thing. And I really had to learn to go at it and figure it out. But a lot of it was just keeping things manageable around the house.
Yeah.
And we were young, but we got through it, and it forced me to be disciplined and budget things out, and worked out well.
Yeah, for a lot of friend house hacks, I've always heard it's like, you just get what you can. And then every time the roommate, you're all in your 20s, they're like, well, I bought the beer last week, so let me take, $18 off the rent. And you're like, it's not really the way this works, but whatever, it's still having fun.
Yeah, to break out the math a lot of the times. Here's the mortgage payment, and here's the utilities, and let's divide this by 5 and look at where we're at. But it served me very well. I'm very glad I did it, and getting that kind of ground experience was a good thing, and able to snowball that money into other projects and other things along the way.
Yeah. So, I mean, what did you do from there, and how did you kind of get going into a point where you're like, wow, I'm really doing this. I'm doing what my grandfather did. This is what I love. Outside of RealSource, you're obviously working on your own to try to develop a portfolio and do something that you saw somebody in your family do, at least from afar as a child.
Yeah, I mean, I heard about RealSource's business model at dinner, and just immediately kind of fell in love with the, hey, wonder if you're not just like looking at where to invest in your own market, in your own backyard, but wonder if there was like a programmatic, tactical way to look at the whole country and say, where's the best place to buy and why? And that just really appealed to me. So I jumped in and kind of started at the bottom and worked real hard and got super into how we run our econometric model and how we pick our markets and find our properties, and just grew into it. Had a good mentor here at RealSource, and it's been a great thing and good ride so far.
Yeah, I think there's a lot of people now after COVID who are mobile with their jobs, so they kind of make a choice. Where should I move to? If I can move anywhere, where is the most affordable place that they can move to? And then also for those other people, where's going to be the best investment? These are some of the metrics that you guys are tracking to make sure that these are improving markets with likelihood of appreciation and success, right?
Yeah, I mean, it's amazing. I don't know if the numbers still hold, but a few years ago, I used to talk about Colorado Springs. And at the time, I think there were only 10 or 12 teams in the Big Ten conference. But it's like you have more people moving to Colorado than all of the rest of those Midwest states at the time. And it's amazing because there's a lot of people that they graduate college and they say, where am I going to go? And it's going to be about lifestyle and where they can get a good paying job. And there's been a lot of that migration. And now today, I think you see a lot of migration coming out of California, which is a lot of renters. Unfortunately, as affordability, stresses society, it's more of the renters that kind of move because they have to rather than they want to. But we're definitely seeing those migration patterns pick up. It's interesting because we've seen the rush to the suburbs. Now we're seeing a little bit of a rebound back to the cities a little bit. But if you can get ahead of the migration patterns and understand them and understand where they might indicate things like cap rates are undervalued or overvalued, it's a good way to take a tactical approach to where you're investing.
Yeah, is that what appealed to you so much that it's a more of a numbers based approach? I mean, obviously, you're going to take all the experience that you gain over the years, but when you're new, you can kind of walk into a model that's projecting based on actual data instead of somebody out there on the internet just throwing darts because they live in Indianapolis, which is a good market, but it's not based on full metrics for somebody who lives there and only wants to do that market.
Yeah, I mean, I think cycles always kind of came natural to me and was always very curious. But the more you dive in, and you always hear every market's different, and a lot of that key drivers is just the housing supply and demand. And so, that differs metro to metro. So even though there still may be kind of an industry macro cycle and a credit cycle and a business cycle, once you kind of understand, where to go, how to get in, how to get out, do the value add, own a property for 3 to 5 years and go to the next place. I mean, it's very powerful how you can generate higher returns and not just investing in your own market or nearby. When I first started, it was very uncomfortable for most investors to not invest somewhere they couldn't drive. I
Yeah.
mean, I had a lot of conversations and with people that are like, hey, I can't buy anything that I can't drive to. And then they started doing the camera system, and that got people comfortable. Now it just doesn't even come up.
Yeah. I
Really
mean, just go
comfortable.
on Google, have someone show up with a phone and show you what's there. But how did you yourself go to out of state investing pretty quickly because you saw that there was scale there? And, after you did that first live in house hack with your friends in college?
Yeah, I mean, it really became going where RealSource goes, and spent a lot of time talking to people on the coast and in California and saying, hey, single family is great, but have you seen what multifamily can offer and the cash flow? That's where I started, bought a lot of deals in Texas and Colorado and Oklahoma. Later saw, the Carolinas were a little undervalued and was able to get, play the cap rate waves there and buying a lot of stuff at high 6 cap rates that one point went down to 4s.
Yeah.
And so that's really been with RealSource has been most of my out of state investing, because you want to invest with a group that you trust, like-minded individuals, get the economies of scale, business plan, and value add. And that's where I found I can maximize the returns.
Yeah, for your personal investments, when you're even if you're linking in obviously with other people, do you have a preference between a value add multifamily and something that's not necessarily turnkey, but more like an operational redo? Because there's a different payment plan on both of those if it's a syndication.
Yeah, I mean, I'm really kind of all about the value add. I mean, I underwrite hundreds of deals with our team here at RealSource, and really what's kind of losing out right now is returns. I mean, that pendulum is really stuck a little closer to the sellers, and everybody's holding, and it seems like most of the time the only people are selling are the people that have been in it a long time or have to sell. And so returns are tighter than they've been, and people are prudent as we've kind of come out, and a lot of people have been burned. So I think a lot of that's for good reason. But to really get the attractive returns, it's got to be value add, and I'm like to focus more on the interior value add process. And if you can buy a couple hundred units where there's demand for turn a 1980s kitchen to a modern kitchen and get the carpet out and get the right flooring in and get hard surfaces, you're not resurfacing, and earn that higher rent by making it a nicer, cleaner place to live with good services. So yes, I'm all about the value add strategy, but I think you got to be careful with those sponsors. I mean, I remember jumping into value add early 2011, and by 2018, every deal that hit the market on or off market was a value add, right? So
Yeah, I like what you said about earning the uptick in rent, because that's important, because that's really part of the process. But the better that you do, the more rent that you're going to earn, and then again also operationalizing it better, because when you find a value add, it's usually not just that it's not outdated but they have really awesome management. Those two things really never go together, or they would have done updates along the way. So you kind of get a double windfall in that one, where you're going to do, of course, it costs money, but you're going to do cosmetic upgrades, interior, exterior, but you're also going to upgrade the operationalization of the multifamily property, which can include, the rental services and anything else on site management and things like that, because again, those two things are never running together, a dump and good management.
Yeah, and it's gotten a lot harder to find those, repositions by management and operations. They're definitely out there, but I think when you start looking at like 150 units and above, it's tougher to find. But we just did one deal last year to where the current owner had bought it in 2020, bought it at the right time, but bought on a variable rate.
Yeah.
So he'd just been trying to keep his head above water, was playing the efficiency game too strong, didn't have professional management or even a website. And so it was a little bit smaller deal than we preferred, but it is tougher to find those properties that kind of have both.
Yeah.
But it's really important to make sure you're in a market where there is the demand for those renovated units. And sometimes people are selling a dream, and the dream's attainable as far as where the property can go. And you got to really know your checklist and what to do to make sure that you're buying it at the right price, and that you're looking at what are the operations going forward. Obviously property taxes and insurance, making sure you're looking at, we used to talk about tax adjusted cap rates. I think now we're going to talk about cap and insurance adjusted cap rates going forward.
Yeah, for sure. I mean, a lot of people got in trouble just because they not only had variable rate, but they also got hit with a 2x to 4x in insurance that they didn't plan for in advance. And there's just, like you were saying before, maybe there's not as many. I feel like the sellers that kind of need to sell but aren't selling, they're, as you said, just holding on for dear life. They're like, can they get through this so they can get something better? But I think there's a lot in trouble in the multifamily space, a lot because of the variable rates and bridge loans. But there's other things there that happened with value add where they couldn't complete as well, right?
Yeah, and I think a lot of those banks are starting to kind of take back those assets if they think they can get a good operator in. But it's just very interesting that they're not selling. I mean, so many people wanted to target, bank owned assets the last few years. And yes, there's been plenty done, but not near at the volume people thought they'd be able to find. So there's a lot of those closed end funds that had funds for distressed product that couldn't go and fill the volume. And now they're going to have to relook at kind of a value add approach. But I do think there's some amazing opportunities out there for kind of the people that do operate on their own, the people that do play in kind of the, say, 20 to 100 unit apartment buildings, to where the institutional people are not chasing them. The cap rates kind of have adjusted a little bit, are settling down. There's a lot of good deals out there to be had. I mean, we're seeing better deals in the last 6 months than we had the previous 24 or 30 months.
Yeah. And what's your general number? Because you said before the last one you bought was a little bit lower, and even 20 to 100 is probably low comparatively because it's, again, not in that major asset. What's like a comfortable number, or what was it before and what is it now if those 20 to 100s are actually looking pretty solid?
Yeah. I mean, we're almost always above 200. That's where you get kind of the operational economies of scale. You can put 2 leasing, 2 maintenance staff on there. But sometimes if it's in a market to where we own another property and we can kind of operate them a little bit together and share staff when needed, we'll kind of look at other opportunities. So this one that we bought that was a little bit less than 100 units was next to one of our most successful properties that was doing very well. So we realized we could get unique economies of scale in that market and operate them a little bit together.
Yeah. And as you were saying, it's different buyers and different sellers under 100 and over, 100, but really over 200 is the big players who can buy. So if you operationalize and value add that 200 plus, there's plenty of buyers for it if you've done it the right way. Whereas if you're under 100, it's a different subset of buyers because the funds aren't coming in to take those. They're just not big enough.
Yeah, I mean, we see a lot of interesting deals. I mean, we've got one local that's like 15 townhomes went into foreclosure, pick them up 65, 70 cents on the dollar. And so you don't want to spend a lot of time on that stuff, but we're back to that market to where you start seeing that and go, well, I definitely know who would want to buy that. And I don't think those opportunities are going to last very long here, but you're starting to see them. It's just really hard to find that deep discount on 200 and over. And it's about finding what markets are undervalued at this time. And that's what we're focused on.
Hey, it's Jonathan. I hope you're enjoying this episode with Mike Madsen of RealSource. And if you're into multifamily and if you own multifamily or any investment property, maybe you've thought about cost segregation. If you're interested in cost segregation, my guy and former guest Sean Graham of Maven Cost Segregation has opportunities for you. You can use my link at mavencostseg.com/green, and green has an E at the end. Let's get back to Mike. Are there any markets right now that you guys are really hot on that you think for the rest of 2025, those are going to be real markets to at least keep an eye on to see what's going to pop up there based on all the data that you're looking at in the background?
Yeah, we like a lot of the major metros in North Carolina, kind of measuring things on a state level. North Carolina's got a lot of positive aspects on both the city level and state level. We think we currently own about 6 assets in North Carolina, but it seems to always rank in our model in the top 10 year in and year out. Ohio has been a really great play. We started buying there in 2017, kind of got there a little bit before it was kind of headline news. But if you're looking for yield and rent growth and no new supply wave kind of slowing you down, I think Cincinnati and Columbus are still pretty strong plays right now. Your basis is really good. We've always kind of had a general philosophy of, buying certain gap below replacement costs, and that's served us well. And then I think there's other markets that you might see a little bit of oversupply happening and slowing down rent growth in 2024, but it's starting to surprise that rent growth's back in 2025. And so I think some of those Mountain West states, I think Salt Lake, Colorado Springs, even Dallas, or Nashville, yes, there's supply, but the demand and other factors make it a good kind of long-term investment. But we really look at things on like a 5-year horizon is where we kind of try to underwrite. We kind of compare where B-class rents are to A-class rents and things like that. But those are a few of the markets that show up on our target market list. And we really try to focus on 10 to 15, but you're really finding you get traction and get deals done and closer to 5 of them each year.
Yeah, and do you have a preference and if you're doing value add, are you always trying to go from B to A or A minus to A, or will you go down and take a C plus and move it up to B? What are the metrics that you're looking for there, depending on the neighborhood classification? Which again is still generalized. Nobody really knows what B and C is as a metric, but you kind of know it when you see it.
Yeah, I mean, I think a lot of people are trying to move up the quality scale and trade out older assets for newer assets and serve people well. We definitely seen the B-class rent growth way outperform A-class rent growth for most of the last 10 years. I think that'll shift just a little bit, but we're really kind of focused and learned how much the building code changed in the 70s to the 80s. And so we really have stayed away from buying 70s product for that reason. But there's other conversations that have come up of like what kind of type of yield would 70s have to start showing for you to get interested. And I do think there's a few markets that if other things line up, you kind of start to look at it a little bit. But for us, we're mostly buying traditionally 80s and newer. Our eye is more on 90s and newer, and we're focused on what we call a gap analysis between kind of where those B-class rents are from the A-class rents, and making sure we're in markets that have that wider gap and give us that extra boost if we renovate.
And that the code differential from the 70s, is that more for the actual kind of overall safety or insurance concept for the building, or is it also based on old plumbing and electric, which can cost a lot more than some people think if it needs a full redo?
I think it's both. I think depending on the climate and market, the foundation issues can be key, but it's really just, yeah, a lot of it was just a kind of a lot looser policy. You could build what you want, less oversight and regulation that kind of protects the integrity and safety of things. So well, that's mostly what it's about. And there's always exceptions to that, but a lot of the markets, it also kind of depends on that curb appeal. I think garden style really kind of took off in the 80s, and people want to feel like they're kind of living more in a condo than brick square building. But there's a lot of markets to where most of the apartments are brick square buildings, especially in the Atlantic coast and things like that. But we're really trying to find those renters that are kind of eventually probably moving to home ownership or moving to A class, focus a little bit on kind of the 2-bedroom factor. I think one thing is inflation's hit people is that we've really noticed that the 2 bedrooms usually have 2 people paying the rent, and that makes a little bit of a difference right now as well.
Yeah, that's a good point. I mean, it's kind of like buying a 4-family instead of a 2-family. If one unit goes empty, you still have 3 options instead of just one. So 2 tenants, at least somebody loses a job, there's somebody else there who can pay. That actually makes a lot of sense, because I always wonder about the configuration, in terms of what the bedrooms counts are. But some people like doing studios, but as you said, then that's usually going to be one person. So if they suffer a hardship, you're at a rent there, and you just want to make sure the rent's coming in all the time to keep everything kind of smooth.
Yeah, it's always a little bit of case by case basis. I mean, the same thing with 3 bedrooms, sometimes a little bit more wear and tear, roommates, probably, a little more bodies in the unit. But I think it's also good to have a little bit of diversity in your unit mix as well.
Yeah.
Have just all 2x2s or all, 2-bedroom, 1-bathrooms, things like that.
Yeah, I mean, there's no way to reposition someone inside the development when they're all the same. Sometimes a 1-bedroom, they meet someone, now they want a 2-bedroom. So then when you open up, you can move them within the development too as well. But you can't do it if it's all just 2-1 and they need a 3, then they're going to leave.
Yeah, and a lot of the work from home, there are a lot of people that want to and decide to live by themselves and live in a 2-bedroom and have an office too. So we did notice that trend change quite a bit.
Yeah, when you're looking at value adds, are you looking for something that has, I would say, a lesser occupancy, so you have the opportunity to do a value add, quicker on some amount of units? Because we've seen people struggle who say they're doing a value add, but it's 92% occupied and nobody's leaving, so they can't really get as much value add as they want on the interiors because the leases are still going for a decent amount of time.
Yeah, and I think that's where I guess you kind of raise the rent a little bit and say, you can stay, but we're trying to renovate and fix up the property. If you want to pay this much, it makes sense to stay, but that's usually a factor that can help you get renovations done where you want to. But for us, it's really about looking at the interior of the property. We want to be in a good neighborhood, good school district, trending the right way. I'm not going to ever try to battle, crime. But when interest rates were super low and you could finance your CapEx and banks would loan you 80% of LTV, and oh, by the way, we'll loan you 80% of your value add budget, and your interest rate is 3.5%. A lot more was getting done, and I think people were kind of leaning a little bit into kind of over renovating, and the wind was at our back and rents were moving, and people were trying to figure out how much of this is because of what I'm doing versus just the tide rising and lifting everybody. Yeah. And I think there was a big shift that needed to happen. And we talked a lot about it with our operations and construction management team and saying, hey, we don't want to find something with heavy deferred. We don't want something that needs new roofs, and it's not always a deal killer, but we've got to bake it in a little bit different and for sure understand what the CapEx needs are at the property. What is it going to cost? But more and more people are kind of leaning away from the properties with the heavy deferred and just really focus on, okay, where can I, add a dog park and a playground and spruce up the pool area and really redo the interior. I mean, the best thing we can see is, 80s or 90s product in a good location, and start looking at the property, and the older that kitchen looks, the better. And
yeah,
it's really kind of that delta of kind of before and after.
Yeah. And I think the kind of amenitization of these properties is helping, because it's kind of like almost a short-term rental lens on apartment complexes, because people want more amenities now because they may not be buying. They may not be getting to that single family home in the same time that they want. So if they're going to rent, they may want that pool or that playground or a potential like office co-work on site. So there's a lot of opportunities for multifamily to add a few more amenities that maybe no one thought about before, but that could play a big role in the upgrade of rent now.
Yeah, definitely. We've seen all those things happening and try to spend wisely, but overall it's, you want to find less deferred and more room for improvement, and you better be a sharpshooter and analyzing what that's going to cost and finding, what is going to help you improve your performance of the property and what is not. Just the vinyl plank flooring, I mean, we talk about all the time. I mean, you should have vinyl plank flooring on your first floors in every apartment, and there's some cases to where maybe you have it in some of the bedrooms. But I mean, it's amazing how much you can kind of spend just churning through carpet and even hard surfaces. I mean, doing hard surfaces costs a lot more than it used to.
Yeah.
If you go back in time, and a lot of people chose not to do hard surface, probably wish they did, and looks at their resurfacing numbers and goes, man, we've spent more resurfacing these counters in the last 8 years than if we would have just put granite in.
Yeah. Yeah. The carpet thing never made sense to me. I mean, if you're on a second level or above, if you always have someone below, I mean, the carpets make sense from a noise perspective, but it's just, you pretty much have to change them out when somebody leaves. They just never get clean again. Nobody really wants that. But, over the years, you've seen plenty of places with old carpets. It's just gross to me. It's just unnecessary.
Right.
Yeah. Is there like an amenity or an upgrade that you feel is like very important right now for what we saw after COVID and how people are living just for apartments? I mean, I know you're talking about interior renovation being so important. Obviously, extra space available for that work from home is there, but any other things that are making sense that you're going to have to put in or upgrade when you're finding these 80s to 90s properties?
Yeah, I mean, I think the Zoom rooms or places to where people can gather around the table, even if it's just for work stuff or meetings, and they work from home and they don't want to meet in their apartment is really important. I think that's kind of depends on the demographic and how close you are to the urban core. The electric car charger thing is really hit more A than B. I think it's trending that way. I don't think it's as strong as you might think, kind of depending on the market, but that's a critical one. But I think a lot of it is just making sure that you're taking good care of the resident, and if something's wrong, you're communicating and fixing things. And I think that a customer service factor is really important right now too. Obviously having good Wi-Fi. I mean, really just been kind of waiting for Wi-Fi to go to just be an amenity.
Yeah, I agree. I don't think that it doesn't seem to cost that much to make it not something that you could give away or at least charge in as part of the rent. But it has to be good, right? You get 200 people on Wi-Fi, it's going to be messy. So got to figure out what people want for the whole, for that type of product.
Yeah, and that's an important one to get right. I mean, when you're buying in bulk, you can really save a lot of money. I mean, what somebody might pay $80 for on their own, you might be able to secure it for 35 or 40.
Right.
And then if it's a certain market and a certain cable company, like, oh, by the way, we can throw in the cable TV and it's going to cost $15 more. Not everybody wants that kind of mixed, but all of a sudden, if you're offering both and you're offering it for less than they'd pay on their own,
Yeah.
it makes sense. But to me, it just comes down to at what point is it just going to be, here's how fast our internet is, and it's one of our amenities and it's included. And I think we'll get there, but not quite there in most markets yet.
Yeah, I think it has to match where the price is still going to look good when you add it on. And if you have enough competition in the area, you can't really just add it on the top because it just looks too much.
Right. Exactly.
That's the look. It's what they perceive as being of value. And maybe they're just not seeing it that way. I think you're right. Eventually it will happen, but there's not enough fluctuation there to do it in most places, I would assume.
Yep. No, you're exactly right. You don't want to look $40 higher than everyone else, I guess.
Yeah, with generally the same, like it looks the same in pictures, and then all you're saying is, "Hey, free Wi-Fi," but people think, "Oh, well, it's free. It's free." No, there's a cost to it, and it's hard to in very quick rental meetings or even in advertising to explain. No, we bought in bulk. You're going to get this for free. They don't have it for free. That's like too much work. At least now, I do think eventually, best case scenario, everything's including. For people, it was just easier. But again, like the same, if you're including electric and gas, it's great, but then your rents are going to look abnormally gigantic, But like when you're looking at small multifamily, it does make a difference when you see, like heat's included in a cold state. That's huge. So, but it's just, you can't manage that on a larger scale because you're trying to advertise to the masses to fill 200 units.
Yeah. And I'd say the other one is washer and dryers in the units. I think we're quickly moving to where more and more apartments just need to be that way, but they're not all set up that way. But you want to factor that in when you're comparing to your rent and sales columns.
Yeah, pets, washer and dryers are huge things that can get you extra money over things in the market because it's just such a pain to have somebody else touch your laundry. It's just, it's aggravating for apartment goers to still, even if they have a lot of washer and dryers, there's still always that thing. You're upstairs and your clothes are downstairs,
Yeah.
Yeah. So, I mean, structurally, though, you really have to plan for that because it's not like the easiest thing to take an 80s development and then find a closet where you can get everything for laundry in there. So it really, if you're doing it new, it makes sense. But the older ones, you have to either get creative or figure something out.
Yeah, definitely be part of the value add process. You just got to know how you're going to do it and how much it's going to cost, and hopefully have a good team to get wholesale pricing on the labor and execution.
Yeah. Well, so tell us more about what you guys do at RealSource Residential. And that is, the best place is realsourceresidential.com. That's the website where people can find you guys.
Yep. We are primarily putting people in multifamily deals and helping them find like-minded investors and help serving people that are out there kind of looking for passive income. They want to be in the loop. They want to see the reports month to month. They want to get on calls and ask questions. They want to pick the market and pick the property, but we work very hard to earn repeat business, and we've done so for over 30 years. What kind of sets us apart a little bit is just our niche for identifying the target markets. The roots of our company kind of come from real estate research. And so for a long time, we would just sell the research and the target markets. And that's kind of where we started. And we've grown into, hey, let's do this together. Let's buy this together. Let's take advantage of the economies of scale. So we're value add multifamily investment group. We're very risk management sensitive, risk management in our underwriting and our debt structure, understanding where we're at in the cycle, playing defense later in the cycle, which has paid off very well for us.
Yeah.
We've done very well these last few years. And, we really value that we weren't out there buying for a few years because there just wasn't the right deals. We've always been pretty big proponents of fixed rate debt. Sometimes we'd renovate for 24 months and convert back when the debt was attractive, but we're very prudent kind of asset managers, making sure that we have the right reports and software to give our clients, the reporting and updates that they need. But it's paid off very well for us to use this econometric model. It's 35 key metrics on 160 states. We track the offensive metros. We triangulate them from different sources. What does RealPage have for the metro rent growth going forward versus CoStar and others? What has been the historic growth? And so we've really just molded and worked this model to help let the data kind of lead us and let the data kind of boil it down to the top 30. And then from there, we say it's kind of an art and a science. We kind of use, where are our relationships? Where can we get track records? Where is there not insurance risk? Getting economies of scale on operating and getting to know a market is important. So we may put some credence in places that we've owned in before.
Yeah.
So we kind of let that boil it down to the top 10. And we go out and find the right deals for our investors. We invest alongside of our investors, and we set it up so we succeed when the investor succeeds. And we've been doing that for over 30 years and done it very well.
Yeah, I like that, because then the top 10 is kind of a conglomeration of different needs. It could be a new market, but maybe it's number 4 because you have all these things in other markets. So the deal may look good in one particular city, but if you're brand new there, you don't have the connection. So it may not rank as high, but it gives you options to start looking. Well, we need to try to get something going in that market. But if you're ready to buy, it might be wiser to buy, hey, we already have 4 in Cincinnati. Like, let's pick up a 5th. Like you're saying, economies of scale. We've got the management, we've got the brokers. We know everybody. We know the city. We know how to do the value add. They know us, which is a big deal. But eventually you do have to break other markets, but you use your history in similar markets, right, to adjust to the new market.
Right. I mean, sourcing the deal is still about relationships business. People like to talk a lot about on market or off market, and people are afraid to take an on market deal to the investment committee. But really, I think when we talk on market and off market, the question should be is there a listing or selling broker fee involved?
Yeah.
And if there's a selling broker fee involved, it's went to the market. It's how it went to the market.
Yeah.
Those relationships are very important, especially in a seller's market. Having that broker endorse you, or, hey, we've done deals with them, or, hey, this guy closed in spring of 2020. They know what they're doing. They do what they say they're going to do. Really, really matters. And I'd say kind of the other key thing and magic of what we do is, finding the pinpointed range of what a property's value is today is a lot simpler than saying, okay, what is this property's potential? What can it be worth later? What will it be worth later? And if you execute this plan. And so that's really the magic of what I think we do. We have made our own acquisitions underwriting model. We have our own construction management team that gets in there and helps us figure out exactly what something's going to cost when we go and tour and inspect a property, to make sure that our underwriting is accurate and prudent. And we have a long checklist and a lot of people that have worked together for 10 or 15 years in the process and really learn from each other and listen from each other. And it's a big part of it.
Yeah, I mean, having so many deals under your belt is really the key to the due diligence being correct. New people are just getting bids. I don't know you don't know if the bids are going to be right, and you don't know what you're going to uncover. But if you did 2 in the area, you know what happens when you have to change out, the giant boiler. You know what's going to be there. Those are invaluable resources. And sometimes those are harder to explain to your new people, which is why, as you were saying, what you guys like and what all people who are running funds or syndications like is repeat business, the same people coming in and just referring other people in, because sometimes it's hard to explain the model to a brand new person if they haven't been sent to it by somebody else who says, this is for you. If you want passive income, talk to them. That's what works. Am I right about this?
Yeah, definitely. I mean, the field's gotten a little crowded, and it's almost a good natural part of the process to wash out a lot of the people who aren't doing it right. I mean, for example, Ohio has really kind of goofy property tax laws and how people buy property through the entity. And,
Oh, yeah. You're right. Yeah. It's
so,
crazy.
Yeah. So 2017 or 18, you might be bidding on someone that's just banking on those taxes not going up. And so more and more people come in and start doing that. That's not who you want to be, in the bidding pool, which most 200 unit properties are going to go through that bidding process. And so now I think it's a little bit different. So many people have been burned. And if you go and you buy in Ohio, that value is going to trade at, 95% of what the new tax rate's going to be, whether it happens in year 1 or year 5.
Yeah.
And it's a little bit of just hit and miss on that. But I mean, I guess that's my advice to those that are just jumping into it and looking to go with sponsors and find that passive income and cash flow is kind of, as they say, put faith in the jockey, not just the horse, and look at the sponsor and look at their track record, look at their history of real estate owned, and don't get over focused on the returns, because sometimes, and you know this, but if you're not a prudent underwriter, it's easy to put out a 20 IRR. But
yeah.
I'd really just stress that and a lot of people probably know this and have been through it and learned in the process. But if you're new to it, just really be careful of who your sponsor is, how they do business. The number one thing to me is, what is your basis? What is your LTV, and what is your debt structure?
Yeah.
And I think if a lot more people were focused on that, there'd be a few more success stories than we've seen in the last few years. But what a great time to get in. I mean, if you look back at, like, obviously what we're going through and went through is not 2008, 2009, but right now it does still kind of remind me of that kind of 2013, 14 kind of opportunity. I don't think people knew at the time how great a time it was to get in.
Yeah.
I think in a few years, we're going to look back and say, yeah, as long as if you were in these top 10 markets, this was the bottom and this is the time to get in. But at the same time, the rent growth and outlook is so bifurcated because of the supply concentration that it is kind of hard to paint it with a broad brush sometimes.
Yeah. Awesome. So as I was saying, the best place for people to get in touch with you specifically and with the company is at realsourceresidential.com.
Yep. You can send me an email too. I don't mind giving out my email, madsen@realsource.net. I've had many conversations with a lot of like-minded investors over the last 20 years, and I enjoy jumping into it and talking real estate and talking markets. If you want to know kind of what our top markets are, or you're circling a deal in a certain market and just want to